Welcome back to Alex Lavender on YouTube. I'm, of course, your host, Mark, and I'm joined, as always, by Alex Lavender, a certified mortgage broker extraordinaire. Alex, we want to know that HELOC rates are changing really fast in Nova Scotia. So should someone still use a HELOC to get access to equity? How exactly do HELOC rates work in Nova Scotia?
Yeah, so a HELOC can be a good tool in the right scenario. It really depends on what you're looking to do. And I say HELOCs are always really good if you want to be able to draw down money quickly and pay it back quickly as well. It's not a great solution if you're going to have it as a long-term balance owing on a HELOC because the interest rate is higher. And the interest rate can fluctuate because it's a variable rate. So a lot of the times, maybe I'm just trying to think of some scenarios like a business owner. It can be really beneficial to have this because they can draw some money during, seasonal changes in their business to provide some cash flow or equipment financing. And then as the money comes back in from sales, they can pay this back down. So there are some really good scenarios that pan out. Now, in terms of rates, it is higher than a mortgage. A lot of the times it can be around 0.5%, maybe 1% higher than what a mortgage would be. So if you're not going to pay that money back quickly, it's better to have it in a mortgage instead of as a line of credit because that interest rate is higher and the payments are interest only.
Got it. So is it possible then, you said it might be better to have it in a mortgage. If someone was looking at this and saying, I want to get access to some of the equity in my house, but I'd rather pay a lower interest rate. You mentioned that you can get that through a mortgage. What would that look like? Like, what if I'm already in a mortgage right now?
Yeah, so you can do a refinance, which is where you just take equity out of your home, it goes into your bank account, and then your mortgage is that amount. So for instance, if your mortgage was 100,000 and you wanted 50,000 out of the house, you could do a refinance for 150,000. And then you'd have 50,000 in your bank. A HELOC is when you have access to the equity in your home, but you don't necessarily need to use it. So you could have a credit line for $100,000. If you don't draw anything, there's no payments. But if you fully draw it, then you're going to have payments on 100,000. So yeah, it's based on what the ultimate goal of it is. And I'd say one clarification of a HELOC and how it differs from a secured line of credit is that as you pay your mortgage down, you get more and more room on your home equity line of credit. So for instance, let's say the mortgage was $200,000 and you have 50,000 on a HELOC and 150,000 on your mortgage. If you paid down that mortgage 25,000, now your mortgage is 125,000 and you have 75,000 available on the HELOC. So it does make it really easy to access the equity in your home as you pay down your mortgage.
Got it. And if you're watching this video and you're curious and want to learn more about refinancing a mortgage, we will link to a video that we did on that up in this corner, I think, and we'll also link to it in the description on this video. So, Alex, you were mentioning on using a HELOC in a few different use cases. Let's say I want to do some renovations on my home. Would you recommend that we use a HELOC or a refinance?
Great question. Blend of both. So I would say that you use a refinance for all the money that you're very confident are going to be used in the refinance. In the renovation. So let's say the renovation is 75,000. Take that out, take that 75,000 equity out, put it in your bank, and then have a HELOC available for an extra 25 or 50. Because a lot of the times people get into renovations, there's a surprise, maybe you have to change contractors, materials change, whatever. We see a lot of these renovation budgets exceed what the original price was. So it'd be good to have that additional access. But unless you intend on paying that money right back down after you complete those renovations, maybe within 6 months, it doesn't make sense to have it on a home equity line of credit because you're going to be just paying a higher rate and you're not going to be paying it down. So, if you know that this is going to be a long-term debt, it's better to just roll it into the mortgage right off the bat.
Got it. That makes a lot of sense. And now let's talk about home equity line of credit rates, HELOC rates in Nova Scotia specifically. How are they really, how do they interact with, with the Bank of Canada rates? And how are they really, where do they range from? Because you mentioned that they're usually about 0.5% to 1% above a mortgage rate, I believe. Mm-hmm. And so how do those rates change? What impacts it?
Yeah, so all HELOCs are variable rate products. So the interest rate can fluctuate as you have it. and it'll be based off of prime. And some lenders will offer lower rates based on how big the HELOC is. So the larger the HELOC, the lower the rate you can get as well. So typically speaking, let's just say it's prime plus 0.5%. That's pretty average. I would say it can range from prime to prime plus 1. So prime today is 4.7. So that would make the rate 5.2% on a HELOC, and it can change if prime changes.
Got it. If I want to get a HELOC, do I have to go to the lender that I have my mortgage with, or can I use a different company for a HELOC?
Yeah, that's a great question and something that we see a lot, and probably a misconception too. So when you're getting a HELOC, it has to be through the lender you currently have the mortgage with. And for a true HELOC, as you pay down your mortgage, the HELOC grows. I mean, the limit on your line of credit grows. So just naturally, it would have to be the same lender. Now, there may be a possibility to get a secured line of credit from your bank behind whatever financial institution currently holds the mortgage, but that is a little bit different. That's not going to grow like a HELOC is. That's probably going to be a higher interest rate. That would be a secured line of credit product instead of a home equity line of credit product.
Got it. So lots of benefits to using a HELOC, it sounds like. But what are the risks and warnings? You've done, thousands of mortgages for Nova Scotians and thousands of HELOCs too. Where do you see people make mistakes? What are the things we should be looking forward, be aware of when you using a HELOC?
Yeah, it's a really good question you brought up, because I'd say one of the biggest risks is that it gives you access to the equity in your home. So if you do not have good discipline with credit, then it's probably not a good idea to have a large home equity line of credit limit. It makes it very easy to just, it could be $100,000 and you can just access it right off a card. And home debt is perceived differently than line of credit debt or credit card debt in general, because you feel like it's your money that you're entitled to, which it is. I mean, you own the home, you own the asset, but at the end of the day, you still have to pay it back. So it doesn't matter if it's on a line of credit or credit card, or if it's secured against your house, you still have to pay that money back at the end of the day. So I think that perception mixed with the ease of how easy it is to take the money out can be one of the biggest risks. The other thing too is that it's variable. So if there are interest rate fluctuations in the market, you can see those payments continually go up higher and higher. And also they're interest only payments. So the minimum payment set only is covering the interest. It doesn't cover any principal on the loan. So if you just do those minimum payments, you're not going to be paying it down at all.
Got it. So when it comes to using a HELOC, you mentioned that we have to go with the current lender that we have a mortgage with. If our mortgage is coming up for renewal and we want to get a mortgage plus a HELOC, do we still have to go with the same lender, or is that an area where we can then, engage someone like yourself, a mortgage broker, and will you be able to give us options for that, or are we still stuck with that same lender?
Yeah, so when you're up for renewal, it's a great time to add a home equity line of credit. That's the best time to make the switch, because you're not going to have any sort of penalties to do so. You can get it all set up and have it there and available if you need it. You may be able to do it through your existing lender. It just depends if your existing lender offers a home equity line of credit or not. When we do these, we typically need to go through the big five banks because they are the main providers of HELOC style mortgages. There are a couple other providers out there as well, such as Manulife with the Manulife One, just to name one. But we would see what product suits you best and what the goal is and who's going to have the combination of the lowest interest rate on not only the mortgage, but the line of credit. So sometimes that's a bit of a balancing act where one lender may have a lower mortgage rate, but another lender may have a lower line of credit rate. You just got to see, which one is the bigger amount and how much the difference is in rate, and then recommend that as the better product of the two.
Got it. So if someone is out there, they're looking for a mortgage and a HELOC, you're coming up for renewal, use the link down below this video, reach out to Alex and see if you can get some options, because you're not just stuck with the same bank that you've always been with. So I personally highly recommend using a mortgage broker so you can see more options. And like you said, Alex, when your mortgage is up for renewal, that's a great time to do it. So use the link down below or go to alexlavender.ca and reach out and get started with your new mortgage and HELOC. Okay, Video numero play.
Get it done.
3 and 20. So this one is going to be on, can you assume a mortgage in Canada? I mean, I'm pretty comfortable with this, but anything that you want to include or exclude or like context with this? Because I know there's some like weird things with this sometimes.
No, this one is a little weird,
Yeah.
but no, this is good.
Okay.
It's good, yeah.
Welcome back to Alex Lavender on YouTube. I am, of course, your host, Mark, and I'm joined, as always, by Alex Lavender, certified mortgage broker extraordinaire. Alex, the people want to know, can you take somebody else's low rate mortgage when you're buying their property? Let's discuss about like what is an assumable mortgage and like, is this even possible for Canadians? Because I see this stuff online all the time, just like, hey, someone's selling their house. I want to assume your mortgage. Is that possible? What does it look like here in Canada?
Yeah, thanks, Mark. This was a hot topic in 2023, 2024, I would say, when there was a lot of people that took out rates at 1.5%, 1.8% in 2020 and 2021. And the rates were in the 5 or 6% range. So we were getting a lot of inquiries about this. You almost need to have like a perfect unicorn situation to make an assumption work. It's not as easy as you think. We do see a lot of people advertising it, on listings. Not as much now, but it was then because it was a big selling feature for sure. But essentially, you are taking over the existing mortgage from the existing seller of the home, and they're switching your names. That's probably the simplest thing. Everything needs to remain the same, though. Interest rate needs to remain the same. The amount needs to remain the same. The only thing that's really changing is who owns the mortgage. There are exceptions to that, and you have to see if that lender will grant an exception, but generally speaking, that's the way it works. And that's what makes it so difficult to use as well. Because let's say you're buying a home for $500,000 and the current owner has a mortgage of $198,000. Well, you need to come up with a $302,000 down payment, for example. And someone wants to put 5% down, it's not an option. So it's one of those situations where it's very tricky to get both parties to line up perfectly.
Is this something that's like common in Canada? Because you do see it a lot online, especially in the US market, I would say. But how common do you see this? You've obviously, helped thousands of Canadians get into mortgages. How often do you see people assuming mortgages?
Not very often. You see a lot of inquiries about assuming a mortgage, but because of the fact that it's so difficult to kind of match up perfectly, you don't see many of them go through. They're very hard to pull off. Yeah, they're very hard to pull off. So there's not many. No.
Got it. And if someone were to assume a mortgage, what's like the high level breakdown of the steps needed in order to go through with this?
Yeah, that's a great question. So, I mean, at the beginning, you need to have an offer on the house that's agreed upon of what you're going to buy it for. And then after that, you need to engage the financial institution that currently has the mortgage. And what they will do, so like the seller is going to have a mortgage with X bank. So you're going to need to work with the seller and X bank to have them reach out to look at this assumption. They're going to do a full application to make sure that you qualify for it and that everything checks out. You get your documents, all of that. And then essentially after that's approved, it would go to a lawyer who would do the assumption. Essentially, they would take your down payment funds. They would remove the existing owner from the title, add you to title, put you on the mortgage, take you off the mortgage, etc. And not all mortgages are assumable either. That's another thing.
Which mortgages are not assumable?
The mortgages that in the contract it says are not assumable. I'm going to say most of the banks' mortgages, the big five banks, they are assumable I would say most of them are. But it can vary. I mean, it can vary between mortgage products too. So like maybe a fixed rate mortgage is assumable and a variable rate mortgage isn't assumable. So that really varies by lender, and that's in the fine print of the contract.
Got it. That makes sense. So when it comes to assuming a mortgage, it seems like there's a lot of pieces that need to be lined up and in place. What other risks or things should people be aware of if they are considering assuming a mortgage?
The biggest thing is a lot of the times people have to come up with a significantly larger down payment than they're expecting. So, and another, I don't know if it's a risk, but a lot of the times, the standard mortgage is 5 years. So if someone's selling the home, they're probably 2 or 3 years into that. So you're going to be assuming a mortgage that maybe has 2 years of length left. So you do have to see if it's beneficial enough to maybe have a larger down payment than you were wanting to use to assume this mortgage product. So yeah, I would say that.
Got it. Is this more common in the like commercial industry? You know, if I'm buying like a rental building that has like 30 units, is this more common there or not?
A good question. You know what? I don't do any commercial, so I can't say specifically. On the residential side, I know it's not that common. And you mentioned in the States, it's a lot more common, which does make sense because in the States, like we have 5-year terms, but in the States, a lot of them have longer terms, such as like 30-year terms as well. So there's a lot more benefits to assumability, I would say, with that, especially if, if someone has a 5% rate and the going rate in the market's 9%, and you can lock that in for the next 20 years, that's going to be, a huge savings as well.
Yeah, definitely. And can a mortgage broker, like someone like yourself, can you help facilitate assuming a mortgage? Or is that done between like the buyer and seller during the real estate purchase agreement?
Yeah, typically we can't help facilitate an assumption. That typically needs to be done directly through the lender, because they are going to do it all in-house, and essentially they're keeping the mortgage the same. They're just changing the registrants or the owners of the mortgage. So everything else is essentially staying the same at the end of the day. Porting a mortgage, which is a little different, is something that we can sometimes assist with.
And what exactly is porting a mortgage? And by the way, if you're watching this on YouTube, we have a video on porting a mortgage, which we will link to in the description down below.
Yeah. So porting a mortgage is when you own the property and the mortgage, and you're essentially just switching properties, but you're keeping the mortgage the same. So mortgage is staying the same. You're just moving it to a new property.
Got it. And that's something that a mortgage broker can help out with.
Most of the time, yeah, we can help out with that. Sometimes it has to go through the lender as well. Really just depends on who the lender is. Yeah.
Okay. Got it. So if you have been trying to assume a mortgage and it's not working out, or you're trying to port a mortgage and you're having problems and you're stuck, then I would recommend that you reach out to Alex Lavender. You can go to alexlavender.ca or use the link down below this video, and he can help you get lined up with a mortgage from a variety of different lenders. And if you are watching this video still, please subscribe to Alex Lavender on YouTube, and we will see you in the next video.